Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, guys, today I'm excited to welcome back a returning guest, someone who's been an active real estate investor for now more than 3 decades and has taken somewhat of a non-traditional approach to real estate investing. We'll talk more about that here today. And that guest is Chris Prefontaine. Now, Chris built his early career through traditional investing, like a lot of us do. But after the 2008 crash, he ultimately pivoted to creative acquisition strategies that didn't rely upon banks, credit of any type, or even any personal capital. And so, Chris is known as the foremost expert in lease options, owner financing, and subject to deals. So creative financing strategies across the board, and he's built an entire business and also a coaching platform, mentoring platform around these powerful tools that he uses in his very own business. Now, he's the founder of Smart Real Estate Coach, which is a program that teaches investors how to build cash flow today, long-term wealth tomorrow, and then everything in between using his signature 3 Paydays strategy. Now, he's also actively investing in other types of assets outside of traditional residential and small multifamily real estate, including asset classes like self-storage. And this is all while really staying laser focused on, again, creative financing strategies, and then also creating financial freedom and helping others achieve that as well. And so, guys, in today's episode, we're going to be catching up with everything Chris is up to nowadays, anything he's been working on and what's new in his world. And so without further ado, I'd like to welcome my guest for today's show, Chris Prefontaine. My friend, how you doing?
I'm awesome, Kevin. Thanks for having me back, and always good to hang out.
Yeah, excited to have you here and excited to talk shop. It's been a few years. I didn't look back to exactly how long, but it's definitely been a few years. My guess is probably sometime during COVID
Yeah.
when we last spoke. So excited to chat with you about what's going on in your world. And so, but before we dive into kind of the meat and potatoes of it all, maybe for those that aren't familiar with you and who you are and your backstory, take a few minutes and tell our listeners a little bit more about yourself, if you would.
Yeah, I won't put him to sleep because it's been 34 years this fall, but I'll just give you high points and you can pull me back to any piece of that. So I built homes back in the 90s. We were doing it creatively then without knowing it. I was sort of in my 20s and naive because we were putting homes on lots that we didn't own. The owner would wait for their money, and then we'd build a whole house, and the vendors would all wait for their money, and then until the house cashed out and we sold it. So I don't know if I'd ask everybody to do that now, but it worked back then when I was sort of naive. We then bought and built a franchise in the realtor world, in the brokerage world. I sold to Coldwell Banker in 2000. And then running up to the crash, I had all kinds of conventional investments like you alluded to. And then I got beat up financially, and then that led to mentally getting beat up after the 2008 crash. But that was the impetus to do what we're doing now, and you kind of alluded to that as well, which is I had no credit and I had no cash. So I said, okay, if I'm going to get back on the saddle, what the heck am I going to do? And that was just creative real estate. So the lease purchasing, the owner finance, and the sub two, because I had no choice. Now, fast forward to today, we, being the family company, still buy and sell that way here, Kevin, locally, but we also now are in 80 markets with we call them associates, but they're community members that have come in to learn real estate or to tack this on to their current niches. And we do that exact same methods with them in these 80 markets. So it's been an interesting few years since we chatted because that's grown a lot. And it's been a lot of fun. So that's kind of the 10,000 foot view.
Okay, I appreciate that, my friend. Let's back up to '08. Just curious to know, what ultimately were the biggest challenges as it related to, I guess traditional investing and what pain you felt during the 2008 crisis. I mean, what did that look like in your business?
Yeah, mainly because I was going out then almost every project and either putting a construction loan if it was a condominium conversion, we did a lot of those,
Hmm.
or in private money on top of that, right, to get the whole thing done. And then when the market tanked, I mean, I'll give you an example. We had units in a 6 unit building we bought, converting them to condos, selling like hotcakes, three of them at like 175 grand. We got to the fourth unit and the market had dipped. We couldn't give it away for 60 grand. Like we just said we got left with 3 units. So it was crazy. And so the lessons there, I was on all that stuff personally. Like there was 20
Yeah.
something projects going on or keepers or projects in the works. And so that was painful. And I couldn't get financing, but now in hindsight, I just don't do it. Unless it's for personal residence that I can't, find another place that I want in that area. But even now I don't do that because I'm debt free. But it's just that was the signing personally piece of it. and stupidly leveraging, probably, admittedly, during all
Yeah.
that. Because everybody thought it was an ATM, right? Yeah, it's just going to keep going. No
Yeah.
go.
It's interesting. I remember the condo conversion craze that took place. I was down here in Florida then, and folks were buying entire apartment complexes and doing condo conversions. And I remember when everything the music stopped, right? Like there was one actually pretty close to me, about 10 minutes away. It was over 300 units. It was fairly
Wow.
large, and they made it about 40% of the way through before the market completely tanked. And they literally couldn't give the units away. I mean, I'm curious to see if there's another period of time, and maybe it's not. I don't really follow that world, but we know there's a shortage of housing in the marketplace. And I'm just curious if there's ever a point in time here in the coming years or even decades where that condo conversion strategy actually takes place again. I think we're kind of turning more to a renter nation, and so I think there's more demand for rental units than there are for sale units at this point in time. But it'd be interesting to see if that ever flip flops back to what we recall, prior to 2008. So
I
time will
would
tell.
agree. I watch it because certain markets might not like once it hit each market, I watched it like on Island here. Just boom, the multis went through the roof, right? And you couldn't, they didn't even make any sense anymore because they knew what all the developers were doing. I think it might make sense on smaller ones. I'm talking like the 3 to 10 units, nothing
Sure.
crazy. But the bigger ones, yeah, I agree. Like, why would you, at least do it knowing you could eventually convert, but stay with the apartments for now?
Right, right, agreed. So, I mentioned in that introduction about your, one of your strategies. I think you coined it 3 paydays. What, maybe tell our listeners a little bit more about what that means and, what that system really is.
Yeah, on the residential side, and let me just preface this so for disclosure, like when I teach, say, let me say from the stage, like globally, I teach single families. Why? Because people all say, well, can't you do this with any asset? Yeah, of course you can. You said that earlier. But I don't want people to get shiny object syndrome in my community, right? So I start with that just for the skill set. And then they can go off and we got a lady that does only mobiles. We got a lady that does only self-storage. So that's fine. You can do this with any asset class. But I think it's important to know that we start off with that for that reason. And I'm sorry, I got off track on you. What was your main question on that one?
Yeah, no, it's just, I mean, just
3 paydays.
three paydays. So,
Sorry.
what does that
Yeah.
strategy? Please define it if you would.
Because it's residential, that's why I was going there. For the 3 paydays is mainly residential, and that means we're putting who in our homes? Buyers. And these buyers need time. Either they need time because they started a new job. Since we've chatted on your show, for example, the boom on people leaving their job and starting new businesses is through the roof. And so those people, as you know, can't they come out the multiple six-figure earners and they go into their new business and they're not bankable yet. 2 years of seasoning typically. I heard it's getting worse. So the 3 paydays work like this. That person, let's use that person, comes out of the W-2, they got good money, they got down payment, they're ready to buy, and they just find out, Stonewall, you're not financeable yet with your new venture. So that payday one is they come to the table with a down payment. So that's our payday one, non-refundable down payment. They will get credit for that eventually when they cash it out. They're in a rent-to-own vehicle while they get mortgage ready.
Hmm.
Payday two then is what? We're paying the owner something if it's owner financing or the underlying debt. And whatever that is, we're going to get more than that from the tenant buyer while they're on their route to mortgage readiness. And that delta becomes ours. That's payday two. Payday three is pretty cool because payday three is any markup in the property, but also all of that principal pay down throughout the term of the rent to own path. And what's neat is when we do owner financing, that principal pay down is usually 100% to the seller. So that's a massive payday three when we do that. And there's other advanced strategies, but that's just how basic and how the 3 paydays work.
Okay, no, good deal. What is the typical duration of one of these rent to own programs? I mean, it takes a couple years of seasoning before, using the example of a business owner, before they're bankable. Do you find that a lot of these cash out in the first couple of years, or do you have any that have run a much longer duration?
Answer is both. Here's why. Your typical, if you keep your finger on the pulse and hold them to the right mortgage ready plan because you have a date ticking on your term with the seller, then you're going to be in that 18 to 30 month range. However, when we buy sub two or even longer terms in owner financing, it's not like we're pushing them to get that cashed out fast, right? We keep an eye on it, but they're going to go through their motions. And if you give them more time, they usually take more time. So those will get pushed out to maybe 3 to 4 years. And then if they're good and we have a longer term, we're going to switch them to owner financing anyway and not have them cash out. So now we become the bank, right? So that they prove themselves and then we take them through the owner financing route. That's more advanced, but that's a way to stay in and get more than your 3 paydays. Now you're getting a fourth essentially because you're the bank.
Gotcha. So I'm assuming, the rise of interest rates over the last couple of years really hasn't impacted your business, but probably actually helped it because maybe some of the deals that you're taking over, maybe it's a sub two or just taking over existing underlying debt, it probably has some pretty good debt in place. Is that an accurate statement?
Yeah, crazy good rates. You're spot on. Yeah.
Yeah.
There's still, I don't have the stats in front of me, but the amount of rates under six, under five, and frankly under three are still staggering. There's a lot of properties out there. So every month, I won't say every week, but every month in the community, we're seeing some really cool rates, 2, 3, 4% coming over with sub twos. Yeah. Because now that it's much cheaper for a lot of these buyers to go through a rent to own program until they get mortgage ready, that is, than it is to go get their loan today. Right?
Yeah.
They get a better, but during the qualification process, because we care about cashing them out, we do make sure that that's disclosed and planned for with the third party we use, because we're not them getting to the end and going, oh, I can't afford it. I've been paying X the whole time, right? So we want to make sure we qualify them right. We set them up to win. Our default rate's like 2 to 10%. That's a far cry from what most people do who teach this.
Yeah. I'm curious to know. I'm a huge fan of creative strategies. I mean, the majority of the time, I say 9 out of 10 times, I would always rather have a seller finance a property for us. It's just easier, even if the terms aren't as great as what we can get from a bank. It's just less
Exactly.
brain damage and a much
Exactly.
quicker, seamless transaction. However, I will never ever, if it's an opportunity that fits our buy box, it's going to hit a return. It's in a great market. It's a great asset. Something that we want to own for a very long period of time. I would never allow the lack of creative structure, creative terms from a seller to um, keep us away from buying that deal, taking it down. And so I'm just curious how you guys look at that in your business. If you've got a seller that's like, hey, Chris, I just want cashed out, buddy. I don't want to, let you take this over sub two. I don't want to, I own it free and clear, but I don't want to carry financing on.
Yeah.
You're gonna pay me more, right? You're gonna give me a higher, a great rate, and I'm gonna get, good cash flow in this thing, and it's better than where I'm going to put my money in the bank. You get some of
Yeah.
those sellers that are stubborn, right? They're just like,
Yeah.
I just want my cash, even though I don't know what to do with it. I just want my cash, right? So I can just be clear, clean cut. How do you
Yeah.
handle those?
If they're killer deals, to your point, we'll look at them. When I say we, it could be the students that we're advising them as well. Some of those, a lot of the community members are bankable, so that's going to be up to them. I personally, at my stage, choose not to. Like we're looking at buildings now. I sold my building that we had our office and we bought it owner financing. We're looking at buildings now, so I put an LOI last week for owner financing, and they said no, amicably. They're like open, but not now. And I said, okay, just wait. And the realtor said, well, why don't you come in conventionally with less? I said, nah, I'm all set. Like, that's me personally. That doesn't mean one of the students wouldn't bring that. And I go, okay, if you're a game for X, Y, and Z, then do it. Right. So it just depends on their
Yeah.
palate too. And of course, their bankability.
Yep. How are you sourcing deals today? What's your business look like behind the scenes? I mean, where are most of the leads coming from?
The basic, I'll say ham and egg boring ones, we still do, and then I'll give you a new list we're on. But that's like the expired, the for sale by owner, the for rent by owner. For rent by owners are pretty cool now because you get a lot of tired landlords, rightfully so, after all that went on. The new list we're on right now is pretty unique to our community. It's pretty cool. It's just called distress, and most people think that's like pre-NOD or pre-foreclosure. This is actually way before that. It's pulling the data for people that are late on utility, late on
Ah,
auto, late on the things that you don't see usually right away. And that's a really cool list. So we're mailing in, calling that list. Our virtual assistants are. And so far, so good. It's only been like 3 months, but we vetted that before bringing it to the community. And it's a really cool, it's a good way to diversify, right? And
interesting.
never be stuck on one kind of funnel.
Yeah, I'm curious. Have you been working that list long enough to know, what a conversion looks like compared to maybe some of the
Not
other
yet.
types of lists? Okay.
Yeah, not yet. I'm just pleased with the amount we're getting so far for responses, because they don't know what we know, right? They just pick up the
Yeah.
phone. So far so good, but too early. I'd like a year into it before I said that. But yeah, again, it's cheap, right? You get it from the database that we already use, Landvoice, and why not just keep working that for variety? I hate to see anyone, and I've never done it, stay with like, hey, I'm having success with this one niche, right? Out of state owners or whatever it might be, because when the market shifts, you got to be able to shift into different ponds. You might as well have them all going at anyway to keep the variety.
Yeah. Yeah. No, all good. I had mentioned in the introduction there, I think that you're also involved in a few other asset classes. You mentioned that you had bought the building that you guys used to house your business in. You'd bought that in creative financing, so that's commercial. But what other types of real estate outside of residential are you actively involved in?
The larger multi and mobile right now are hot in our community. So there's one woman in my private club. I still coach like the higher end people, and all she does is use our strategies to stay within mobile parks. own some products, own some singles. It just stays within that. So I just work with her like one-on-one, working on that at that asset class in particular. Apartments have always been in the. I mean, it doesn't matter, right? It literally doesn't matter. My building was mixed use, so it doesn't matter what
Mhm.
asset class. But those are the ones that are currently on our radar.
And when you make an offer on owner financing, are you typically trying to make it more attractive for the seller than maybe what if it's priced at 100,000, like maybe you're coming in at a higher price point to maybe persuade them to take the seller financing terms, or how do you approach that?
Yeah, sometimes higher, and some it depends on what the underlying other variables are, right? If there's going to be interest or not. I'll give you an example of that in a second. And sometimes less price because they weren't getting it. Like my building was on, they weren't getting it. Actually, he had people coming in offering them full price, but they wanted to pay cash or they wanted to finance it. And he said, Chris, I didn't get it. I don't want it for tax reasons in estate
Yeah.
planning. He wanted it on financing. So typically, if that's the case, he wasn't looking for a premium. He wanted owner financing for personal reasons. What we do with him, let me tell you a story quick, because on a residential, I'll always get principal, like almost always. With him, I say we do principal only, and he's a big landowner in the area. He's not new to real estate. He almost fell off his chair. He's like, I'm not going to do principal only. So what we did was win-win though. He's a cool guy. We did 18 months of principal only, then took that balance and amortized. I think it was 5.2 at the time, back in 18. Amortized the balance with a 20-year balloon. So he was happy and I was happy. That was a good way to kind of make a hybrid deal and keep us both happy.
Yeah, no, good deal. So let's talk about the next 12 to 24 months. What do you see? Again, you've got your own local marketplace, but again, it sounds like you're across the country.
Yeah.
You're spanning roughly 80 different markets that you're actively involved in and have to keep your finger on the pulse in. So I guess just generally speaking, because everything's market specific, but just generally speaking, what's the next 12 to 24 months look like for your business? Are you guys aggressively in acquisition mode? Do you ever get out of acquisition mode, right? Like, what are you most excited about?
Yeah, I'll tell you, we don't get out of acquisition mode to your point because we can work the creative, as you know, in up, down, or sideways markets. It just, again, what I said earlier, it depends what pond we're fishing in. So right now I'm seeing, because we're a microcosm of society sort of in these 80 markets, I'm seeing some still booming. I'm seeing some flat. And like around here, I couldn't grab a house on island if I had to because it's booming still. It's near the water. Florida, it's the students are like, how many can I possibly look at and which ones are going to be the safe ones to do, right? There's a lot of my students in Florida, there's hand picking deals. What do I see in the next 12 to 24? I mean, the billionaires don't know, so I wish I could tell you I knew. What I know is whenever there's uncertainty, like now in the political and like anything going on that's causing uh-oh for the public because the media screaming, that's when I know it's good for us because they need a guide, right? In creative, it's not like I'm timing the market. It's not like I'm timing geographics. It's not none of that. I'm just bopping and weaving and being able to pivot and be comfortable doing so, knowing creative. So my short answer is I don't really care what the market does. I hope it continues to slightly change in any direction, not just be flat.
Yeah.
That's what I'm excited about because it's going to bring deals.
Have you noticed any value reduction in your market at Rhode Island? I'm sure it's got many different submarkets, even though it's a very small state. But just generally speaking, have you seen any price reduction over the last couple of years since rates have gone up?
Yeah, even in this market where I said is hot, like we're along the water here, you're seeing some multi-million dollar price reductions. So it's not as hot as it used to be, but yeah, I think price reductions and expireds are up everywhere that I can see in our
Yeah.
markets.
Will you ever, in a more expensive market, maybe like you're located in, will you ever do a deal that doesn't necessarily have positive cash flow? Let's say you're going to do a sub two deal, and there's a good amount of equity there. However, for whatever reason, whatever you're going to turn around owner financing for, that monthly payment is going to be negative to what the monthly
Yeah.
obligation, the mortgage. But there's a good potential pop on the back end that you feel very confident about. Will you do a deal like that?
We do. So we look at this is a great question because we look at it holistically. Payday one, two, and three.
Yeah.
If all three paydays are say we had one come in recently, it's 116 grand, and the student said to my son Nick, yeah, but the monthly's like negative, I don't know, it's two or three hundred bucks. So we said, okay, Rick, it's 300 bucks a month, $3,600 a year for 116 grand on the back. Like, yes, we will do it if holistically the deal looks strong, all three paydays. And frankly, if the student or us can afford the cash flow on that, right? All you got to do is take your payday one and take your shortfall and put it away because your payday ones are always strong, like 7, 10% of the property.
Yeah.
So that's how you handle it.
Yeah. 2008 obviously probably took a lot of lessons away from that. One was that I basically don't want to be a signer on a loan. Anytime moving
Not
forward,
personally,
basically,
right?
yeah, not personally, not personally. What other key lessons were a takeaway, post 2008 that you've implemented in your business today?
The big one was the three paydays, and I'll tell you why, because a lot of people out there operate this way. Albeit the money was good for a long time. I have no complaints about what I went to in real estate, but every January I'd go, oh man, like I got to do it again, right? So the treadmill, because it was do a deal, get paid, do a deal, get paid, not any kind of cash flow stream or long-term wealth. And that's where the three paydays came from. So that was a huge lesson because I didn't realize I had my head down hustling. And as you know, to get to $1 million hustling in any business, it's not hard as a solopreneur. I don't want to water that down, but it's not. You work more, you do more, right? You can make it happen. It's to get past that and get out of that transactional seat. That was a big lesson when I had a chance to peel back and go, what the heck did I just do? So the three paydays, the signing personally, and then in the terms world, if you give yourself enough ramp or runway, like long terms, 10 years, do we really care what goes on with the market in between? Because historically, if you could do any 10-year look back, I think most people would
Yeah.
be happy, right? So that's another biggie that we now are doing a lot of just to make sure the students are safe.
Do you ever focus on traditional rentals? If you're going to take over a sub two or some other type of creative strategy from a seller, instead of offering it out in a lease option, do you ever just do a straight rental? And if so, why?
Yeah, we do. Two reasons. Either one, we say this would be a great add to the portfolio, and I'll give you some examples. Or
Okay.
two, someone defaults from a tenant buyer standpoint, that 2 to 10%, and we go, this would be a good keeper. We'll just do it over and keep it.
Got
So
it.
we have one on agreement now that we bought way back. I think it was maybe 2012. We bought two in 2013 that we sold off in January. So yeah, some of these we keep. And then some of the multis we keep. We pointedly mail or call and get them, and we keep, owner financing, principal only payments, and we keep them. So yeah, absolutely.
It's
It's
good.
just
Good.
balancing it. When students first come in, they go, I want the three paydays, I got to get cash going. And then once they get up to five, six, eight properties, then we start tinkering. I call it wealth stacking. You just start planning accordingly.
Yeah, no, that's great. I mean, you'd mentioned, you wanted to stop being transactional. That's where the question came from. Is that
Yeah.
ultimately at some point in time you want to start holding assets that they have positive cash flow, start putting them into a portfolio. Things that become legacy assets that are in great locations, great markets, and
Right.
are somewhat irreplaceable, right? So that
Yeah.
you don't have to get on that hamster wheel again and again each and every January 1st.
Yeah.
Um, Talk to me about staying motivated. I mean, you've been doing this 3+ decades. You said 34 years, I think was the
Yeah.
exact
This
time
fall.
frame.
Yeah.
So
Yeah.
talk to me about staying motivated, being excited every day about what you do and just, keeping a positive outlook. How do you do it?
Yeah, two things, Kevin. One is always having a why. People, yeah, yeah, I got a why, but if you dig into it, they usually don't. It's not emotional. Like my why is different now, but it's changed over the years. When you hone into a why, it can be fun and it can be pretty emotionally fun too. Meaning for me now, it's creating experiences with the family. I've got parents who are in their late 80s. I've got grandkids 5 and 7 years old. So it's creating experiences with and for them. So you have enough money and wealth to do the things that money and wealth can't buy. So that's
Yeah.
presently what keeps me rolling. The second thing in creative is simply that it is creative. Like there's never a deal, literally never a deal that we have or a student brings, and I go, oh yeah, I've seen, 100 of those. They're all different slightly. And so it keeps me going, keeps me fresh. As soon as it gets boring, I'll stop doing it.
And I believe that you've got your family involved in the business, correct? I
Yeah.
recall, was it your son or is there more
Uh,
than that?
Yeah, my son Nick handles the buyer side, both for
Okay.
us and for the students. My son-in-law Zach and partner and wicked smart, smart real estate coach. He handles more of the growth and the scaling, where I love just in the trenches doing deals. My daughter doesn't work for us anymore. She did, but the kids are 5 and 7 now, so I took her out of the picture.
Talk to me about some lessons that you've learned now working with family. I find a lot of folks struggle with that, whether it be a spouse or, a sibling or even a child. Obviously, it creates additional, challenges and friction. But, talk to me about how you've been able to manage that over the years and create successful business around family.
Two things. One is simple, and the next one's just more layered. The simple one is keep it separate. Like there
Hmm.
was a time when we started when I had moved from my big house to a one-bedroom apartment when I had to start over. And next door to us was my son Nick, and diagonally across the street was my son-in-law Zach and my daughter Kayla. Like we were right together. The office was a block away. We'd get home, see each other in the yard, and go, "Hey, how was your day?" Like we never saw each other. Just keep it separate. Never bring negative home.
Yeah.
Bring the wins home, sure, but never bring the negative. The second thing, more from a corporate standpoint, anyone could mimic is there are different outfits that teach, but have followed elite entrepreneurs since 2017 as far as how we scale and our meeting rhythm and our mission, values, and purpose. The important piece of that whole thing was the mission, value, and purpose, because once we establish the values together, the decisions are based on that, not based on family personality, right?
Got it.
So it takes it off the table. And does it go to our values and our mission? If it does, it's a decision that we all can easily make. If not, it has nothing to do with personality and family.
Yeah,
That's a
no, I love
biggie.
it. I love it. How about your program? Tell us a little more about that. For folks that are interested in reaching out to you, learn a little bit more about what you do and what it looks like behind the scenes.
Because you've been at this for a while too, I'll say the biggest frustration has been, and it's like 10 times worse than when I started, are the people that teach in any niche in real estate, not just ours, but they're not coming behind it with anything, right? Support wise. So we've always ran the model sort of interactively. We do deals with the members of the community. So it's not take our course or here's this program. It's okay, now we're in bed together. We're going to revenue share on these deals. Some go 2, 5, 10 years, and we're in the deal with them. They own it, but we're tied to it as a consultant. That's super important for people to know that that support comes behind any of the learning. Because in real estate, as you know, there's
Hmm.
just too many curveballs without
Yeah.
that. So that's what we call our associate program. We have an apprentice program that's more group coaching that gives them access though to 5 calls a week if they want it and their schedule allows. That's a lot of touch for
Yeah.
low end group coaching program. So that's what we offer: the apprentice program and the associate program in the main online platform for learning, Wicked Smart Academy.
Yeah. Where's the best place to track that information down? What's the website or where should they go?
SmartRealestateCoach.com is the basic site. And as I did last time, I'm sure we did, we'll give all your listeners a book. And it's not one of those offers that, put in $10 for shipping, but it's supposedly free. It's free. You put your name and address and we'll send you a free book. Just go to wickedsmartbooks.com/Kevin and the number two, numeric number two. You'll get a free bundle of books and some goodies in zero charge. I'm big on free because of all the noise out there, especially with social media.
There's a lot of noise.
Yep. Yep.
That's why I always joke around and say like back, probably you could probably attest to this as well. I've been at this now 24 years, so
Yeah.
you've got a decade on me. But back then, getting involved, I remember it was basically on tapes or CDs, right? A program, and there were some books and things like that. But there weren't forums. The
Right.
web was a very new thing. It was very difficult to track down good information. There was local real estate investment clubs, not where I grew up, but that was an option. But nowadays, there's so much out there. It's
It
really
is.
difficult to really work your way through the noise. I mean, just with podcasts alone, right? Like we're
Yeah.
recording one of these, but you go on Apple or Spotify, wherever you download your podcast and type in real estate investing. I mean, it's pages and pages and pages of information. It's like, where do I focus my energy and effort?
Yeah.
And I think to your point, I mean, the support mechanism behind the scenes is the important aspect of it all, right? If you're going to tie yourself to a coach, you're going to buy into a program, ensure that there's a support mechanism and there's some functionality behind the scenes that can hold your hand along the way. I mean, so inevitably there's going to be challenges you face that, in theory, you can read about it in a book about how to, work your way through it, but having, someone there that's real, that's been through it many other times, that can give you more specific guidance is incredibly important. So, I mean, I wouldn't be where I'm at today if it wasn't for multiple mentors over the years.
Right.
And even today, I still have, mentors. There's folks I rely upon. We built a pretty large business, but, again, every stage of growth we go through, I haven't been there yet, and I got to rely upon someone else to help me get there. And so
Yeah.
anyway, just for what you guys are doing, it's fantastic. I love to hear all the growth. I can't remember what you had referenced as far as how many markets you were in a couple years ago when we spoke, but it definitely wasn't 80. So
No,
kudos
it
to
wasn't
you
80.
and
I
your
don't I
success.
don't know what it was. Maybe in the teens, but yeah, and that's why, everything you just said, Kevin, that's why we started. It wasn't my idea. It was Zach's the apprentice program. Because he's like, look, a lot of people with all the noise out there don't know what's behind the curtain. And now we bring them in our office here privately, and they're literally doing deals with us, like right here at my stand-up desk. And they're going, oh, okay, so you guys just do what you say you do. Yeah, that's what we do. But we didn't have that before. Frankly, there wasn't a need. When I was starting after the crash, I think there was 4 names that you and I both know that were with me in the creative space, and that was it. And now it's probably, I don't know, 104, whatever the numbers, it's big.
Yeah, it's a lot. There's a lot. Well, Chris, my friend, I always appreciate you coming on. It's always good catching up with you. Any final words for those that are tuning in? Maybe as it relates to creative finance and just kind of your business model and any advice you might leave them with today.
Let's go with this because we were just talking about mentors. 3 things, and it could be any niche, not just creative. I just think it's important with all the noise to do 3 things. One, find a niche that you can get behind, like personally, morally, ethically. Just there's a lot of cool niches, not just
Yeah.
creative. Find one like that. Two, find a group or a person, or you mentioned clubs, like find something that you can attach to that they've been where you want to go. And I don't mean just business wise, because you and I both know people that screwed up relationships or got divorced because they worked too hard in the business. I'm talking about the whole person or persons. And once you find that, okay, now easier said than done, but put the blinders on for 3 to 7 years and
Yeah.
just go at it. Because when you do that, you'll have a great experience and not go out and do what I call drilling wells, right? All shiny objects. Like you never hit water, you just run around in circles. If you do that, you'll have a great experience in any niche.
Yeah, no, I agree. No, that's great advice. I mean, I always like to say that there's a million and one different ways to make money in real estate. Just pick one that you feel best
Yeah.
aligns with you, whatever that might be, and then go all in. Really, there's no right or wrong. Like there's not one that's better than the other. They're all very different in their own right. And so,
Just keep
for
doing
us,
it.
we chose mobile home parks. 14 years ago. Prior to that, it was we owned a lot of multifamily. Prior to that, it was single family. We've gone through motions. But what it didn't happen all at once, right? I wasn't the guy that was an expert in single family at the same time was an expert in multifamily at the same time. Also dove into mobile home parks and
Yeah.
parking. What should we do today? Like it all took 5 to 7 years. That's probably a good time frame that you had referenced there for us to find our expertise in each one of those niches before we ventured out into another one. And today we stay our lane. We put equal amounts of efforts into mobile home parks, which is one of our verticals, and the other one being parking. But that's all we do. If you ask us to do anything else, I'm going to say no.
Yeah.
I've got personal investments in other stuff, self storage, assisted living, and they're all great asset classes. But for us to actually bring that in house and truly do it as well as someone else that only focuses there, it'd be nearly impossible. So
Yeah.
I think to your point, find that one thing and put your head down, put the blinders on, find others that are doing it that have found success and balance as well, and just go all in. So
Spot on.
with that, my friend, I really appreciate you coming on the show, guys. I'll put all the information about the website, the mentor program that Chris offers. I'll put it all in the show notes. And with that, that's all I have, buddy. So, kudos to you to all this success, and we'll stay in touch. And next, couple of years from now, I'll find out that you're in 280 markets. So I'll look
Yeah.
forward to that
Yeah.
day.
I appreciate you.
All righty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.